Okay, hey, I trust you are doing well and you have had an amazing week. We are wrapping up a week out here in sunny and snowy Lake Tahoe. Just had an amazing week hosting a number of our team members out here, but also just spending some quality family time, making some memories here, but also taking a look at some of the things that have been going on this week. You know, we're working on a number of deals that we're preparing for sale. One that is under contract. And you know what sparked me to think about is what we saw with inflation this week, coming in at 3.8, slightly down from the month before, but also slightly ahead of where the expectation was from the Fed analyst at 3.7. So what does that mean? It means kind of higher for longer. The market had responded earlier this year, the stock and bond market, with an exuberant expectation that rates were going to begin to be cut more rapidly, like, in March and May and June, and, an expectation of 4 cuts this year. That was probably what I would say was an overstretch. So on our best day, we'll probably see 1 rate cut in July and then maybe another in the second half of the year, unless we see something further decline in the overall market conditions. Now that being said, employment is running strong. But if you do notice underneath of that, credit card delinquencies are on the rise. We also see that savings, a lot of that COVID money, savings that have been built up by people has been spent down. People are actually running a deficit now, meaning that the average consumer is spending on credit card and their credit card balances are going up and delinquencies are increasing. The economy, though, again, to everybody's surprise, has been amazingly resilient. As much as they raised interest rates, the fastest and highest that they raised in 40 years. Now, again, that's had an effect, as we've shared, on commercial real estate. It has had an effect on businesses and entrepreneurs that rely on, lines of credit like manufacturing companies, etc. And so, we have to take that into account. But I do want to say this, look, even though rates are higher, and again, we've talked about this in a previous video, they would stay higher for longer. And even as they come down, we don't expect them to come down to pre-pandemic levels or pre-levels of what we saw prior to them raising. We're going to be in a higher interest rate environment. But even with that said, you can still make money in deals depending on the rate and depending upon the acquisition price. There's properties that we bought in 2017 or 18 at a higher rate, 5.4%-ish, and we made good money on it. You know what I mean? And so, us and our investors made good returns. So it's something that I want to say to you that, a lot of times people got kind of adjusted to this lower rate environment and adjusted to the fact that the, Fed had interest rates at near zero. Now we saw, of course, the bond market had responded. 10-year treasuries up about 430 at the shooting of this video. So it's gone up from the 385 of where it was. So going up, 40 basis points almost, which is, unfortunate. Doesn't do anybody any good. But again, that also could change more quickly as any type of deterioration exists in the overall economy. So again, we just have to be, continuously aware, continuously looking at these things. But that being said, look, be prepared and be expecting to be able to make money even in a higher interest rate environment, because that opportunities will be there. And again, even though when the Fed will start to cut rate in the bond market, and again, the overall investment assumptions will respond, we can and you can make money even at a higher interest rate. So again, don't buy into this, some people's philosophy and thought process that interest rates are going to go down quickly. Realistically, as we've shared and talked about, it's probably a more longer term process over 2024, 25, and into 26. So, all right, hey, you have a wonderful and blessed week. Look forward to talking to you again soon. Thank you so much.